Today, we are going to take a look at a case study of a family business. We've got a family in the farming industry. They're also involved in real estate, and they're interested in a whole life insurance policy set up for maximum cash value and flexibility so then they can use it for their business. So we're going to look at exactly how the policy should be set up and then how they can use it for the business. Let's get on into it and have some fun. So to kick things off, age 36, that is the age of the son, which we are looking at the policy on. I have had conversations initially with the father who was interested in the product, had a lot of questions about how the product works and such, but he's interested in taking the policy out primarily on his son, possibly his son's wife as well, but just due to the father's age and the overall planning, it does make sense to go on the son. So the son is 36 years old, who I have also spoke with, and he understands the product and finance in general at a very, very high level. He does a lot of due diligence before committing to a strategy. So he is a business owner, both he and his father are. They are in the farming industry. They also have a lot of real estate investments. And this part is going to be critical to the initial funding of the policy with respect to what they want to do. Here's what they're interested in. Cash value for their business. Specifically, they want to build that cash value up and use it as a line of credit for their business instead of a bank if possible. So as they have made large purchases for their business, as financing needs have come and gone, they've used a bank, as most business owners do, especially if you need to carry a lot of inventory at certain points in time. That's where having a line of credit with a bank, for example, can be very, very valuable. So what they'd like to do is establish their own line of credit and reduce their reliance or their need to go to banks so they've got control. So the thought here is with the cash value, if they can build that up, they'll have their own source of financing here, their own personal line of credit or business line of credit on how they plan on using it. And this will be pretty cool to see. So we're going to look at a model that demonstrates this in a little bit. Why they're interested in that is, one, the policy does continue to compound when you borrow against it, when you look at how loans work. But also, when you look at loan rates right now, they range between 5 and 6%, and that can also be a fixed rate. So where we're at in the interest rate environment right now, where rates with banks are a bit higher, being able to lock in a low fixed loan interest rate is attractive to them. If interest rates go back down and a more attractive rate becomes available with the bank or third-party lender, then they have a cash value collateral loan available, which is when you assign your cash value as collateral to a bank and they give you a line of credit against the cash value. It's a nice option. We've got other videos that talk on it. But my point is, they like the idea of locking in a lower fixed loan interest rate. The death benefit here is important. I spoke with both the father and son. Father had more interest in this. The death benefit from a legacy planning standpoint is important. And the main reason why is because he had mentioned was the previous generation. There's about $21 million passed, and most of it's gone. It was squandered, for lack of a better word. So he does have a trust established. He did mention that it's been revised 3 times already, specifically to prevent this from happening again, where money is passed to the next generation and it's spent unwisely, not in the way that he wants it spent. He wants it to remain in the family and actively used to continue to increase the family's net worth, both their personal and business value. So that's a little overview there. The plan. So we mentioned the real estate before, that they've got some real estate investments and they are selling some of them. So they've got some real estate out in California that they are in the process of liquidating, and they're planning to sell a lot more of it. And as of now, they are expecting to net after tax somewhere between $2 and $2.1 million. So what they want to do is take that, let's call it $2 million, and move it into a policy. So the funding scenario we're going to look at is $500,000 per year for 4 years. That'll be on the son. He does have the option to continue to feed the policy thereafter, but where we wanted to start was just moving that lump sum into the policy. Now, we still are discussing this. In our most recent call, he did ask about a strategy of moving $700,000 per year into the policy over 3 years. He is interested in getting it into the policy quickly, which at his age, that'll look a little bit stronger, but it won't make a huge difference when we look at the performance. And really, when you get to this level and trying to figure out how long you want to spread a lump sum out when moving it into a policy, in this case, really has to do with this: how long is it going to sell some of the properties compared to others? Because with real estate, sometimes we can sell it quickly, other times we can't because things come up that perhaps we didn't expect at all. But my point is, if we build in some more time there, that may be attractive, might not be either. It depends really on him and his situation, or the family situation. What we're going to look at here, we are going to review the company and also product selection. What are the most important things when it comes to maximizing the cash value? Company selection. One of the 4 major mutual companies that have a track record of delivering strong cash values and death benefits, actual performance, not just illustrations. 4 major mutuals are MassMutual, Guardian, New York Life, and Northwestern Mutual. Step 2, policy design. If the policy is designed with a minimum base premium, that will result in maximum cash value upfront, maximum cash value based on the guarantees. We're maximizing the overall value. So if I want to be able to use it through loans, I've got as much possible working capital. That's where cash value maximization really comes into play. So the different options we started with was a MassMutual 10-pay, and then a Guardian L95 policy with a 5% PUA fee and a 10% PUA fee, as those are 2 different options. Same product, that L95 product, but whatever PUA fee I select from the get-go, I'm locked in indefinitely. So very quickly, the 5% PUA fee will give you stronger guaranteed values, and it will also give you more money upfront. So when I focus on the guarantees, I'll see more from start to finish when I look at the 5% PUA fee. When I look at the non-guaranteed values, I will have more upfront for about 12 years. It's typically 10 to 12 years. But then, if I'm looking at the non-guaranteed values, the 10% PUA fee will have significantly more value looking at it from a long-term perspective. But looking at the different carriers here, so MassMutual and Guardian, we use both heavily, cream of the crop when it comes to carriers. Flexibility is the big thing. So when it comes to policy flexibility, Guardian, if I'm paying in $500,000 per year, will allow a design where he can commit to approximately $50,000 per year, 10% of the total amount, and then just add the rest at his discretion. So if he feels that that real estate may sell slower than what he's anticipating, perhaps based on past experience, that's where that flexibility may be nice. Or for example, if he says, hey, I can cash flow the $50K no problem for my business, which he can, and then I can just add the additional funds when the real estate sells, and I don't have to worry about paying the full amount on my premium due date. That's where Guardian is very advantageous based on his particular situation, because he can commit just to the minimum premium. When the premium is due, he only has to pay the $50,000, and then the additional $450,000 can be added at his leisure, and he doesn't even have to add it. Some years he might skip it, then resume the following year. Very, very flexible there. MassMutual, on the other hand, is not quite as flexible, where I can commit to the same $50,000 minimum and then add more money at discretion. What you can do with Mass is send the full $500,000 in. You still have the $50K minimum, but then let's say I send the full $500,000 in the first year. Second year, the real estate sale is delayed, so I only pay in $70,000. If I want to add more money back up to $500,000, I have to wait until the premium due date in order to avoid medical underwriting, if the policy is set up properly. There's a variety of ways to set up MassMutual policies, but if one is comfortable and disciplined to make one-time per year payment adjustments, MassMutual works very, very nicely. But the big difference there is here, Guardian, I can commit to the minimum and add more discretion. MassMutual, if I'm comfortable with a one-time per year payment, $500, $500, $500, $500, it'll work perfectly fine. So What we're going to look at is as follows. First, we are going to review different illustrations just side by side of these three. And then we'll look at a loan demonstration, which will hit on one of their main objectives here, which is to utilize the policy as a line of credit. Let's have some fun, shall we? What we've got here is a side-by-side of the different options, $500K per year for 4 years. He has the option to fund longer than just 4 years. Afterwards, he can continue to pay in $500,000, maybe it's $100,000, maybe it's $50,000. He's not forced to stop after 4 years. That question does come up sometimes. With a 10-pay policy, the premium is due for a maximum of 10 years. The L95, he can pay into it up until the age of 95, so he can keep on feeding it if he wanted to. But we're focusing just on the lump sum, as that is the primary goal right now. So over here, with Mass, $500 in the first year. You've got just over $450,000 in first year cash value, which is about 90% of your payment, a little bit more than that. So rich first year cash value when we look at a whole life insurance policy. What's highlighted in yellow represents the break-even point. And remember, these payments here are coming from real estate sales. Guardian L95 product. First year, $500 in. Very close to that Mass Mutual option. You're at $442 in the first year. Second year, look at this, you're paying $500. You get that back and a little bit more. That's the only option where we see that occur in the second year. If you look at this, back to the Mass option, year 1 to 2, you paid in $500 and you got less than that back. You were at $451 at the end of the first year. If you got your full $500 back in year 2, what would you be at? $951. We're a little bit less than that. So that L95 with that 5% PUA fee is the only option where we see a positive growth rate or positive cash value growth by policy year 2 and a break-even point between years 3 and 4. Great option for strong upfront cash value. Also a great option if you like the stronger guarantees, because this does have the strongest guaranteed cash value, short-term and long-term, when comparing these three. And then you've got the L95 10% PUA fee, which does offer greater long-term potential. The break-even is still attractive there between years 4 and 5. So in a case like this, and really any case, but especially larger numbers, what people often like to see, or I like to show even if they don't ask, to provide more clarity, is the net growth rate and also the total gain. So when I say net growth rate, what I'm referring to is the annual internal rate of return. Just because when someone first discovers whole life insurance, we see these dividend rates associated with a life insurance company. Here, Mass, the dividend rate is 6%. And then Guardian, the dividend rate is 5.75%. You'll never see the internal rate of return hit that dividend rate. And the reason why is because the dividend rate is a gross rate that's applied to the policy after the insurance expenses and such. So as we look at this guy, first year you paid in $500, you've got just over $450, which means you lost about $50,000. That's why we see that negative internal rate of return of a little bit less than 10%. Year 2, you paid in $500, you got a little bit less back than your $500, which is why we see that negative internal rate of return. In year 3, you paid in $500, you got that back and a little bit more. If we got the full $500 back, we would be at what? 1.438, but we're a little bit higher than that. We're at 1.464, which is why we see that positive internal rate of return. Then the total gain on cash value. You'll notice the first 3 years, your total funding is what? 1.5 million. Your cash value is 1.464. That's a loss of $35,000. By the 4th year, total payments are now $2 million. Cash value is $2,018,000 and change. Everything above the $2 million of total funding is the gain. money you're receiving from the insurance company, or you have received from the insurance company, I should say. So you'll see that gain increase over time. And this IRR does assume the company's current dividend rate, their current illustration, what everything shows today. Things will change over the years. And this is where we definitely want to track the actual performance, of course. But we've got the annualized IRR and also the total gain on cash value. And then we'll do the same thing with the other options. And to take it a step further, we may look at the guaranteed values and such, or we would look at that to show a worst case scenario. This way you can really refine your decision-making process, because the first thing that I am going to stress to him, and I did stress to him, is really making sure that the product is selected, A, that maximizes the cash value, but then B, from a flexibility standpoint, you are comfortable with. We talked about MassMutual's and Guardian's flexibility before. If he says, hey, I'm going to have the money there, or hey, I can cash flow the $500K, no problem, with proceeds from my business, and then I can refill the kitty when a piece of property sells, then MassMutual can work fine because I'm comfortable with the one-time per year payments. Guardian, on the other hand, if he says, boy, I love the idea of being able to commit just to $50,000 per year and then pay up to 10x that whenever I want, okay, I'm interested in that. Now we just need to decide between these two options. But this is where it's always beneficial to start. And you can do this by looking at 2 products, sometimes 3. You look at a couple of different companies so we don't have buyer's remorse. The top options, which is what most people gravitate toward, and what products have produced the strongest actual results as we've examined them over time. Let's wrap this up. So we're going to look at the 10% PUA fee option. And here's what we got. So this model does not display direct loans from the life insurance illustration. That is something we will prepare. We do prepare for everyone we work with when they want to see loan illustrations. This is a quick loan workbook that we do send to those we work with so they can really get a quick idea of what the numbers look like. Meaning, if this is me and I'm thinking about borrowing $1.5 million, what's the cash value growing by and how much am I going to pay in interest? That's what I'm interested in. And I want to make sure that I'm not in the red, meaning I don't want to see interest costs higher than what the policy is growing by. So what we've got here, again on the left, the growth illustration. So what you'll notice is the annual outlay, total payments, cash value, and death benefit, but then the annual internal rate of return. This is isolating what the policy is growing by year over year. We just looked at this on the last workbook. But then we've got the yearly cash value growth. For example, year 4 to 5, he pays in nothing. The cash value was $1.959. The following year, it was $2,044,000. How much did it grow by? Isolating the cash value growth that year, $85,000 and change. Year 4 to year 5, that's what I got from the company. That was applied to my cash value. Same thing the following year, a little bit stronger, $89,000 and change. Then you've got the total gain on cash value. If I look at year 10, paid in $2 million, got 2.571. So that $571,000 is the gain. That's how much more I have in cash value than what I've paid in total since day one. So where these are valuable, or why these are valuable when looking at loan scenarios, is because when we start taking loans and seeing how much we're paying in interest, what we can do is compare how much we paid in loan interest each year with how much our policy is growing by each year, and then also our total interest payments. So over the life of a loan, what's the total amount I paid in loan interest, and compare that with my total gain. The column highlighted in yellow, LTV at 95% of cash value. That displays how much you have access to. So let's assume year 4, he wants to take out a loan. We mentioned earlier $1.5 million. He loans $1.5 million. The loan interest rate, 4.76%. Where that came from is this. Guardian has a fixed loan interest rate of 5%. However, if you pay the loan interest annually when it's billed on your premium due date, your policy anniversary date, they apply a discounted rate of 4.76%. That's where that came from. If we're looking at a different product, we would change the rate accordingly. Or if we didn't want to pay the loan interest on the anniversary date, we could increase it to 5%. Here's what I want to look at. Borrowed 1.5. My available equity dropped as a result. Now remember, you're still compounding on your full cash value. Guardian is direct recognition, so the values would be different than what we've got here, full disclosure. But again, this is meant to give us a quick ballpark. So 4.76% of 1.5, $71,400. Here's your cash value growth. It's 1.86, but on the 1.96, $35,000. Rather than looking back and forth in blue, got your comparison. So if you take that loan and never pay it, never pay the principal, just pay interest forever, what happens? Well, you can see each year what the cash value is growing by compared to what you're paying in loan interest. So in year 4, if I take that $1.5 million loan, I'm going to be paying more in loan interest than what I'm receiving from the company. The next year, however, cash value growth is $85,000 and I paid $71,400. I'm positive now. The reason why, because if you look at year 5, the IRR is 4.35%. The loan rate's 4.76%. How am I positive? That 4.35 is on the total cash value, whereas the 4.76 is only on the 1.5 million. So I'm getting the compounding on the entire balance, whereas I'm paying loan interest only on the outstanding loan balance there. So let's pay this off. You know what? Yeah, let's first take another loan, because I want to make sure we're upside down for a little bit, just to make the scenario worse. Let's say year 6, I borrow another $500,000. And that's a good starting point because I paid in $2 million and now I've taken $2 million in loans. I am paying the loan interest. But let's begin to repay it at, let's do $250 a year. We can do it however we want. It can be a lump sum. Some years it can be nothing, but I'm just going to do it consistent here. So as you begin to chip away at that loan, principal goes down, but here's really what people like to look at, including myself. What's the cash value growth compared to the loan interest paid each year? And in this particular model, it looks good. There are 2 years where I'm upside down. If I don't like that, then I would just reduce the amount that I loan those years. If I'm okay with it because it's 1 year, that's fine. Awareness is the key in my opinion. Then the total gain on cash value compared to total interest payments over time. So as we look at these interest payments, this is what it is each year, but we do need to look at the total amount. So what do you have here? By year 9, they're about the same, meaning your total gain's 451, total interest paid is 452. Next year, 571 in a gain compared to about 500,000 in interest payments when I look at it. But again, this is meant to provide awareness so I can see everything up front. Again, if I'm using my policy for business, this is typically what people like to see firsthand. What does it look like? How much is the policy growing by? How much am I paying in loan interest? Am I attracted to this, or do I need to look at a different strategy? When it comes to using the policy, this is something a lot of people, including myself, like to see. So I hope you enjoyed this video. If you did, please let us know. Let us know if you have any questions at all. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.